Friends, in this video, I am going to do the second episode on the topic portfolio quality. To maintain portfolio quality is our priority. To sustain it is a necessity. But in every portfolio, we have other priorities which are more overarching, right? All of us have it. One priority everybody wants is growth. We want to be invested focusing on growth. When I say growth, I mean the businesses should have growth which will later reward us with returns. So, most of the time investors want to be betting on growth and you want to buy businesses which offer you higher growth. While portfolio quality is certainly important, the primary driver in our decision making becomes growth. So, you start looking at businesses which have good growth. Okay. So, as you start looking at businesses which have good growth, what do? You wonder whether they also will show commensurate earnings. So, you start looking at the earnings number closely. When the earnings number also looks reasonably good to you and it is growing, then you start looking at how the market is discounting that earnings. So, by the time you look at growth, you start looking at earnings and then you come to discounting. At that point, you start looking at whether you like the valuation. So, you come to the point where you are judging, right? When you judge that, you try to compare that valuation with a peer or with something else which you already own or what you think is a reasonable valuation. Okay, there are people who have a valuation which is very low as their bar. There are people who have any valuation, I mean they are open to higher valuations. So, both kinds of people are there. Whatever kind you belong to, you start measuring and start assessing what is it that suits me. And when that growth in earnings is acceptable to you, then you start moving towards liking that idea. But it's not so simple. What can really go wrong? That is something you need to address at that point in time. The first thing is, what is the quality of this growth? Is it growth that has happened because of some changes in business dynamics which will reverse, or is it a change in growth which is structural? Okay. Is the growth driven by a lot of liquidity or is it a growth driven by a long term trend? Is that growth driven by availability of cheap money or is that growth driven by a larger economic pattern? Now, these things are usually simple but yet overlooked. Let me give you an example. Between 2005 and 8, we had a massive boom in infra, right? So, if you wanted to have high growth, the kind of high growth which infra company offered, others could not offer. So, they offered growth, they offered sales growth, they offered earnings growth, everything was there. But what was lacking is that growth came at the expense of quality. The balance sheet's quality was continuously deteriorating. Companies were taking more risk to maintain the growth. Their risks were showing up as more debts. They were taking up projects which are much larger than what they had executed earlier. They were stretching their capacity to implement, to deliver projects way beyond what it should be. They were basically doing too much too fast, right? By doing that, they were showing us growth, they were showing us earnings growth, and the valuations seem to be justifying those earnings. Whenever growth is high and whenever that translates into earnings growth, the fact that business growth is high and earnings growth is commensurate is not a no-brainer. You have to see whether that growth is actually coming with a better balance sheet or with better financials, or that growth is coming at the expense of the balance sheet or the financials. Is the company trying to do too many things too fast without protecting its balance sheet, right? That is a question which we must ask. We failed to ask that in 2008. Most people have come to grief for years together subsequently. A lot of growth in emerging companies also belongs to this category. It's not just infra theme of 2008. Even today, a number of companies which are growing very fast are committing this mistake. So, you have to look intensely and it is not easy. Let me tell you why. When the growth is high, the narration from all sources is going to be very good, because everybody wants to spot growth and cling on to it, right? It's a natural feeling. When you want to do that, you start creating a positive narration which puts the growth in front and the earnings growth behind it. So, the business growth or the sales growth and the earnings growth is something which is primary, and most people focus only on that. The public narration, the discourse, what people are talking is all centered around this. People don't go below that line and see how that growth is coming from, where it is coming from, how much capital it is consuming. Because if it is coming without capital, then that's a different quality of growth. But whereas if it is taking too much of incremental capital to provide that growth, then it's a different thing. If all the profits earned by the money is required for the growth, that is one aspect you need to consider. If more than the profits which the company generates in a year is required for the growth, then the company would be borrowing. If a lot more than the profits generated by the company is required to sustain the growth, the company would be borrowing at a breakneck speed, and it would become very heavily leveraged in a short burst of time. All these things complement growth in several emerging companies. You will be seeing that even today in a number of companies, people are all doing capex today in the hope that the growth they had in the last 3 years will sustain over the next 3. But the cyclicality is there in several businesses, and not all businesses will be able to earn the money which they put into the business so easily. In fact, sometimes the businesses are more hungry than what it can be fed with. The capital is never enough for several businesses which grow fast, and that is something that we must be very careful of. So, growth is important, but that growth should not come at the expense of too much of leverage, at the cost of using all the money the company earns, and at the cost of making the balance sheet weaker. So, while it is important to have growth, it is very important to see if that growth is coming with capital efficiency, it is coming in a manner which is sustainable, and it is coming with lower leverage. If this is happening, then such growth companies, when they come into your portfolio, will at least not lower the portfolio quality, and they will help you maintain at least some basic standards of portfolio quality. But if you are holding a company which is giving very stable growth without any capital requirement and is able to pay out all the money that it is earning back to the shareholders, then replacing that company with another company is going to be a very tricky thing, especially if that company which you want to replace it hasn't got those qualities. Then you are consciously coming down one notch at least in the quality ladder to find that replacement, and that question of replacing it itself becomes very difficult. So, growth per se cannot be such a simple factor in making a decision, in deciding to replace a company with another company, and it is extremely nuanced. As an investor, whatever decision you take, you must ensure that by chasing growth, you are not lowering the quality, right? So, by doing that, you are ensuring that the portfolio quality is always above your basic standards or what you would like it to be. Thank you for watching this video. Do stay the course with us on this series on portfolio quality.